Good evening, everyone. A very warm welcome to today's Career Insight webinar. As you know, that we have been running this series for some time, and then we took a break. Today, we are back in the very first episode of this new version of Career Insights webinar. And the topic which we have chosen for today is risk management. And we'll be talking about risk management in general, plus how to navigate the career into this particular area of the finance. I am Rajni Nameja, and I will be your moderator for today's session. As a quick introduction, I'm a CFA charter holder with the experience of close to 2 decades in financial markets. I'm working into fixed income space and have been associated in the fixed income market since last more than 10 years. Before we move on to the session, I would like to mention a couple of instructions. So our session would be for 60 minutes, out of which 45 minutes would be for presentation, and we have left last 10 to 15 minutes for Q&A. I would request each one of you keep on posting your questions in the window during the webinar, and we'll take at the end of the session. So now I introduce our today's speaker, Mr. Biharilal Deora, CFA. He's a CFA charter holder and a rank holder chartered accountant. He is currently director with Abakkus Asset Management Company. It's a India-focused asset manager. In his previous roles, he has advised various clients into multiple asset classes. So without much ado, I would hand over the stage now to Mr. Biharilal Deora. And before we start, Biharilal Deora is fondly known as BD, so I'll be addressing him as BD during the session.
Thank you, Rajni. Thank you for this webinar and thank you for inviting me. It's great and heartening to kind of start, the second series of Career Insights with so many kind of applause in the first series. I'm assuming all of you are able to see my screen. Let me know if there are issues. Otherwise, the presentation would be available for download towards the end. And like Rajni mentioned, please post your questions or Q&A box. We'll try to take them as much as possible towards the end. The idea of this session, again, the way I've divided is I've tried to give you a little bit of risk background in terms of what all risks are generally prevalent at this point in time, how the roles are evolving, how the careers are evolving, what kind of education backgrounds are required, and then essentially go from there to kind of answer your questions on careers. From a career and risk management perspective, and especially we can talk more about capital market, capital market risk will always refer to uncertainty or a potential for financial loss, which is associated with investments in the capital market. A lot of regulators require you to write that as a warning for all investors, but essentially it can be because of any of the factors, which could be volatility, interest rate changes, economic conditions, political events, so on and so forth. And risk management, therefore, has become a very critical function in capital market, to ensure financial stability, protect investor interests, support regulatory compliances, and so on and so forth. And as we go along, it has also become an important perspective to talk about risk management in a sense that it ails decision-making process, largely trading, investments, operation, governance to that extent. And we'll talk more about as we sort of go along with that perspective. From an importance of risk management perspective, we mentioned about investor capital, protect investor capital, decision-making, enhances market stability, promotes and supports regulatory compliance, improves portfolio performance, and that's the interesting aspect for a CFA charter holder, and builds investor confidence to that extent. Now, all of you would have heard about the key areas of risk management. You've known financial risk, you've known operational risk, you've known compliance and regulatory risk, you've known risk which are strategy, cybersecurity, environment, and risk, from that perspective. Now, keep in mind that majority of these kind of risks are pre-existent and they are common across businesses. The only difference is the nature and the type of risk or the impact of it, which might have depending on the type of business. So for example, in a asset manager industry or in an asset manager like us, there might not be a credit risk, but there will be definitely a market volatility. In a lending business, credit risk will be more than the market volatility. For a manager who is managing large pools of money, liquidity challenges are what will impact the capital and profitability to that extent. Anything which is requiring an operation job to be done, not getting that job done or having a process failure will lead to operation risk, right? Whether it is system breakdown, whether it is human error, whether it is anything which can stop operations, right? And you've seen a lot of places where because of errors or otherwise, redemptions are delayed or subscriptions are delayed, and that becomes a critical regulatory sort of burden to be proved in terms of why these processes were not sort of followed. From a compliance and regulatory perspective, anything which involves laws, regulations, industry standards across jurisdictions, and these days businesses have become more global. So anything which is across laws, regulations will become a compliance and regulatory risk. And obviously, each of these risks might be sort of evolving and lying with a different set of business, which you may or may not be managing. But unless you know the importance of these risks, you will not be able to manage it to that extent. Strategic risk is more from a business decision, external environment factors, which can kind of threat your competitiveness. So take an example of a gaming industry. Gaming industry until recently was booming in India. One fine day, regulator, the government came up with the new regulations on whether they are allowed or not. Prior to that, there were some discussions on whether there will be tax impact of GST on that or not, and that kind of changed the entire business itself. Right, overnight, the businesses got shut down with respect to the money, which they were making. Cybersecurity risk has become kind of more prone these days, whether you are working in Asia or Europe or US. Cybersecurity is a big thing. You saw a recent news where a failure in an update of Windows led to disruptions across airports, across exchanges, across so and so places. Data breaches have been very frequent, and with the ongoing of data privacy acts and so on and so forth, things have been becoming very very rampant. I don't expect a risk management professional to be a cybersecurity expert. At the same time, they have to envisage and identify and have appropriate measures to kind of mitigate those risks to that extent. And you might have a specialist for that for all practical matters. You've already read about ESG. ESG again is a new and a big area. Some people call it sustainability, some people call it impact investing. But ESG as a theme is growing in risk management space, especially from meeting stakeholders' expectations or a corporate social responsibility to that extent. Of late, at least in European markets, there are funds which have to be categorized based on ESG ranking, and most of the retail money will only come to funds which have some sort of ESG mandate to that extent. Back home in India, you have the regulatory mandate for mandatory disclosures in terms of annual reports for ESG data. And time and again, I think it will become more with a reasonable assurance or otherwise. From a reporting of risk management, in capital markets, at least the regulation requires you to kind of identify and categorize risk in each of these places. You have to have measures for risk assessments, whether it is tools, whether it is matrices like VAR or stress testing or exposure. You need to have all those quantitative as well as qualitative materials. Post that, there has to be a role which is dedicated to monitoring and control, whether it is through automated systems like trading systems like Bloomberg, Morningstar, and so on and so forth, or other exposure analysis tools like MSCI, BARA, etc. One needs to have it. There could be manual reviews, which are kind of more frequent based on periodic exception reports, highlight breaches, control failures. Those are all required. From a reporting framework, a lot of these risks are required to be reported on a monthly, quarterly, semi-annual, annual basis to management, to trustees, to regulators, or to the independent directors. These includes mitigations, actions, compliance status, restraints of these ideas. At the governance level, more or less, all of us are aware, saying that at a board level, there are governance standards which needs to be followed, whether it is related party transactions, whether it is business disclosures, whether it is board level reviews, whether it is a requirement of audit and risk committee. That part already is aware with respect to people, and a lot of new companies coming up to market these days. These are the discussion points with respect to transparency and accountability over there. And lastly, is majority of this risk reporting has to align with regulators, whether it is local capital market regulators, whether it is securities or banking regulators. There are kind of requirement to have internal policies and external audit requirements from a risk sort of standpoint. So within capital market, there are kind of certain rules which are specific to compliance, but there are other rules which kind of adhere to one of the things which are identified and required in the risk control kind of framework. From a risk sort of management requirement, essentially 3 lines of kind of defense, or as you call it, 3 lines of framework, which you'll have it. You will obviously have risk governance, which is defined in the organization at the core. The business unit where the risk is getting originated, being risk aware itself is the key for that particular business unit. Unless they know what are the standard operating procedure, unless they know the TATs, unless they know the deliverables, for them to kind of identify saying that missing this particular can lead to so and so repercussions, unless they are aware, this won't be possible to kind of control it. And majority of the places you will find that the department in which the risk is generated are not risk aware. As a finance professional, whenever you are kind of talking about these things, the first job is to kind of make sure that the business unit is aware of the risk which is inheriting. The way you select products being part of wealth management, the way you select stocks being part of a portfolio management, a similar way you will have to kind of look at business and identify where the risk is originating and make sure the department understands to that extent. The second line is essentially the risk and compliance, which essentially, make sure that everything compliant, some reportings are done and otherwise. And, the third line essentially is a mitigation perspective, which is from an internal audit, that before a regulator comes and notices, you have, your own internal audit who will cover this particular risk. Now, a lot of you might get confused with respect to saying that audit is a different function and, risk and compliance are different function, but they work hand in hand when it comes to kind of risk mitigation or complying with the risk to that extent. And the role of risk management can exist in any of these kind of 3 lines of defenses which you talked about, over and above risk sort of governance to that extent. Now let's talk about a little bit of the landscape, the categories, and the management tools which are available from risk management perspective. A lot of candidates and members might also be working in a different setup, where either they are working on the tool side, sort of managing this risk, either they're working on the modeling side, or either they're working on a macro side. But as long as they are part of risk management function, some or the other thing would be there to that extent. At a board level, the structure on the risk management, and I've taken an example of a mutual fund in the investment management side. You have the first line of defense, which is the business itself. So the respective CXOs, so whether it is operations, whether it is cybersecurity, whether it is investment, you have the relevant CXOs who are looking at these risks. Whether in terms of business specific areas, you have operation, compliance, technology, reputation, conduct, sales, distribution, financial reporting, legal and tax sort of risk. From an investment perspective, yes, investment risk is there, but you can have credit risk, liquidity, governance, scheme specific compliance risk, or fund specific compliance risk to that extent. Those sort of respective CXOs essentially then put out their findings and reportings to the CRO, which is kind of the second level of defense, which is essentially reports to the CEO and required to kind of be a designated role in an AMC to that extent. And the third line, essentially the internal auditor or external auditor to that extent, who will report to the board of the AMC and the trustee. As you recall, in mutual fund structure, you have a risk management committee of AMC, which is mandatory committee. You have risk management committee of board of trustees, which is a mandatory committee. And the independent oversight, both the boards have to be independent, and they are required to kind of make sure that the risk is identified, documented, tested, mitigated, at the end, at the same time measured to that sort of extent. So in mutual funds, this part is very, very clear because they manage retail money. In other parts of the business, these are more as a best practice. Yes, there are specific limits which are given by SEBI from a perspective of investment risk, or maybe technology risk with respect to cybersecurity guidelines, or compliance risk with respect to reporting. But the other risks, which are operational risk and otherwise, they are required to be audited from an internal audit perspective and presented to the board out there. Now, let's take a sort of quick sort of understanding with respect to different kinds of risk and what kind of roles which are possible in those risks. Now, you might have heard about investment risk. Again, investment risk is common across the entire CFA curriculum and so on and so forth. But the roles which can involve measuring of investment risk or mitigating investment risk is what you do on a day-to-day basis. So the entire investment team, whether it's a research analyst or an associate or whatever you call it, whether it's the fund manager, whether which is the chief investment officer, all of them essentially are doing nothing but managing investment risk, whether it is from stock selection effect, whether it is from sector allocation, whether it is the interaction effect. They are responsible for managing the investment risk of that particular portfolio or strategy, which they are kind of managing to that extent. From a credit risk perspective, yes, there are debt side analysts. You have fund manager who looks at debt. You can have a CIO of debt to that extent who looks at this. You might have other roles with respect to sort of banks or NBFCs or lending institutions, which essentially do your credit appraisal or credit monitoring or counterparty risk, and they look at sort of it from a borrowing or a counterparty default sort of perspective, and those roles can be there in asset management companies. Those roles can be there in non-asset management companies also to that extent. Liquidity risk is essentially largely a subset and usually taken care of by the investment risk or the credit risk team itself, apart from the CRO, largely because, if you don't want to run on the fund in case of a liquidity cycle, which is coming, and you don't want to repeat the lessons which you learned in 2008 post the global financial crisis. Some other risk, which is respect to concentration risk, again, this is kind of very, very widely and, easily defined in our world. So in majority of the regulations, the concentration norms would be designed, whether it is sector specific concentration, whether it is security level concentration, whether it is issuer level concentration or asset class level concentration. Most regulations, whether it is AIF regulation, PMS regulation, mutual fund regulations, whether it is international funds regulations like 40 Act fund or UCITS regulations, you will find that concentration is the easiest risk to define from a regulation standpoint, and most people will have some sort of limits which they have identified to avoid any concentration on the portfolio level or at a firm level to that extent. Some examples you can find on concentration risk are, what's the maximum amount of equity you want to hold for a particular company? What is the maximum amount of equity you want to hold as a percentage of free float of the company? What's the maximum percentage you want to have in terms of a sector? Whether it is deep cyclical, whether you want to reduce your sector exposure, whether it is state-owned entities, you want to reduce your exposure. What's your concentration with respect to, large cap, mid cap, small cap, micro cap, and so on and so forth to that extent. And that is kind of, again, part of CIO, fund manager, and CRO kind of, function to that extent. Governance risk is kind of more broad and overall, again, oversight structures, ethical lapses, compliance gaps, weak internal controls. It is part of compliance officer. It is also part of secretarial role. It is also part of, the board, the CEO, the directors to that extent out there. And it's widely known because the standards are already set with respect to listed companies and, so on and so forth to that extent. It also includes the independence test on the board and otherwise. With respect to operation risk, there could be system failures, like I said, cybersecurity. Now, I've put in cybersecurity as part of operation risk, but you can always have a separate technology risk and put it over there. Fraudulent processing errors, other operational disruptions. Typically looked out by chief operating officer. Again, you might be a process owner, and you might be looking at some of these things to sort of to avoid the risk in those areas. Information technology risk, again, very, very widely prevalent these days, largely kind of looked at by CISO, the Chief Information Security Officer. Some places it is looked at from CTO perspective, the Chief Technology Officers, but you can have separate kind of, managerial levels roles also, which are looking at threat prevention, which are looking at data security, which are looking at server security, and so forth. And every organization, at least from an Indian context, majority of the capital market intermediaries are required to follow cybersecurity, cyber resilience framework, and required to have, expertise on the, information technology system from a risk sort of standpoint. The largest risk today is not that somebody will invade your borders. The largest risk is today that somebody has already invaded your systems and already taken your data, which you might not be sort of aware to that extent. Reputation risk, again, from a credibility standpoint, whether it is violations, whether it is servicing, whether it is other unethical practices, is kind of very widely there. As part of capital market, we are in the business of trust, and as long as the client trust is there, I think things go well. The moment the trust goes down, the risk increases, and people kind of very, very, uh, people are kind of not very comfortable taking those calls at this point in time. In current world, a lot of risk, a lot of activities are being outsourced to providers or intermediaries like RTAs, which is registrar transfer agents or fund accountants or fund administrators or custodians, and there could be data security and other sort of operational risk at those places. Again, ISCO and so many other regulators kind of try to give you a hands down approach on how to manage outsourcing risk. But yes, that's a big risk at these days, that you are dependent on someone else to kind of follow your operations, and if that someone else goes down, maybe you have backup and maybe you don't have backup. Sometimes majority of the places the backup is created in terms of data, that you have the data available with you, but backup is not created in terms of processing power, which creates kind of challenge to that extent. So how do you manage this risk? Again, a lot of tools are available, a lot of techniques are available, within kind of industry to manage or kind of at least to measure those particular risks. And then people make their policies and compliance tests and, test reports around these sort of scenarios to make sure that they understand. And, there's someone who's kind of calculating these things to that extent. At some places, the investment team of the respective business unit itself might be looking at these. At other places, it might be someone else who is designated a risk officer to kind of calculate sort of these risks. Again, these risks are divided based on industry. So there are kind of some risks which are more prevalent in banking side or lending side, some risks which are more prevalent across the board, some risks which are more prevalent with respect to manufacturing businesses and so on and so forth to that extent. On the investment side, I mean, people use VAR, which is value at risk. People use scenario analysis, stress testing, portfolio volatility. I mean, the things like Sharpe and beta and tenor ratios, which you use, the max drawdowns, which you use, essentially are part of your, what you call risk versus historical kind of performance track records. From a credit risk perspective, credit scoring, credit rating, financial statement analysis, a big part of risk. Again, people use ratios. People have multiple tools to kind of stress test certain sort of liquid scenarios. The Z score, which you've heard of, some of those are kind of the tools which are required to measure. Again, the tools may be appropriate, may not be appropriate, but at some point in time, there is something which you need to do in terms of identifying what risk and how to kind of measure it to that extent. On the liquidity side, yes, the ALM mismatch, the cash flow forecasting, the bid-ask spreads, the trading volume, and those things are there. In capital market, the time to liquidate your portfolio without any market impact is something which is calculated and being asked by institutional investors to a great extent. Concentration risk we have talked about. You can have percentage of portfolios in single asset class, single sector, single geography. You can have a tool, calculating Herfindahl index and so on and so forth to kind of identify how concentrated the portfolios are. More diversification also kills, but at the same time, right amount of diversification can kind of build up your returns out there. From a governance risk standpoint, yes, ESG risk we talked about. So ESG globally has kind of started getting rating. So you have each and every company and security now getting ESG rating, which kind of again takes care of their environmental, social governance aspects. The board structure, the reviews, the independence, the shareholder rights, so on and so forth, are essentially part of sort of governance risk, and there are measures and qualitative tools available to kind of look at those things. In terms of operation risk, yes, there is no real measure, but people use a tool called what they call as risk control self-assessment, the RCSA. It's a widely known and used term in the AMC space and within regulatory circles, which talks about incidents, tracking, the internal audits, the loss events, the control effectiveness, and so on and so forth. So these tools are kind of fairly available to that extent. In terms of IT security, there is a host of tools which people use over and above this thing. So for controlled access, people use privileged access management. For patching, people will use certain softwares. For the purpose of threat intelligence, there are advanced measures which are available. For brand monitoring, people use tools and so forth. Followed up with obviously audit to that extent. The reputation analysis, again, brand perception, brand scoring, brand social media sentiment, complaint volumes, they're big task these days. And there are professionals who are managing these things to make sure that your overall impression is kind of being managed over the social media in the world or out there. Outsourcing risk, again, more qualitative, where the vendor risk assessments, the SLA reviews, the compliance audits. A lot of people also do, some sort of counterparty risk assessment, by giving them scores or by giving them criteria which they have to follow, especially players like for broker empanelment policy. It's essentially an outsourcing arrangement, and one needs to kind of look at what kind of brokers they're empaneling, what kind of brokerages they're giving. From a sales and distribution risk perspective, people do mystery shopping, people do compliance checks, they get customer satisfaction scores, feedbacks, so and so, to that extent. The key matrices would include mis-selling cases, the compliance resolution time, the sales quality scores, etc., etc. Financial reporting is more easier to kind of understand, again based on audit findings, clean reports, reconciliation, external reviews, etc. And the compliance, legal, and tax risk is again based on audits, employee compliance rates, reviews, checks, tracking, filing, and timing, and et cetera, which are kind of out there to that extent. So there are some qualitative tools, there are some quantitative tools, and depending on kind of what one wants to use, there are kind of options available in terms of career out there to that extent. So the risk mapping, is required from identifying risk, interdependency, the forward-looking statements. There are quantitative models where people can make career. There are monitoring and reporting sort of, requirements where people can make a career. There are governance controls from with respect to policies, audit, integrations, those things are possible. And then there are mitigation strategies, which could be hedging, diversification, exposure, insurance, and a risk management career is possible across these places when it comes to kind of managing risk out there. Typical career paths, while the titles might look very general across, but be rest assured that these titles are kind of very, very differentiated when it comes to the actual job. So risk analyst is a common title, entry level positions based on data analysis, risk identification, reporting, and depending on the industry which you are in, whether it is BFSI, asset asset management, or otherwise, things would be different out there. Compliance officer is a standard mandatory required role in majority of the regulated businesses, whether it is organizational adherence to regulatory standards, internal policies, those things are required. Credit is something which you all understand fairly easily. It's trying to kind of assess credit worthiness and lend portfolios. Operation risk, like I said, a lot of focus has been put on operation risk since last 5 years. And the idea is to kind of work on resilience strategy with respect to operations, sort of out there. A chief risk officer role has been designated, at least with the mutual fund AMCs and large banks and NBFCs, at least in India from a regulatory standpoint. And that is a designated role which is required, which has to report to the CEO to kind of maintain, risk strategy and governance framework. The other role which has come off late is a role of a cyber security specialist or a cyber risk specialist. Majority of the places, it's the requirement as a CISO, but that role has become more evident as we sort of go along. You might also find similar roles in insurance in terms of underwriting, in terms of actuary, in terms of valuation. But yeah, some of these roles kind of require compliance risk paths to be kind of taken with respect to career trajectory. So depending on where you are, you kind of get a career from where you want to be to that extent. Core competencies are fairly straightforward. Again, I wouldn't find that these are very different from some other roles which you might be aspiring to do. But risk management professionals, must blend technical expertise, must sort of look at strategic thinking, must sort of look at interpersonal skill to navigate, the overall organization challenge. So the analytical thinking and problem solving attitude is kind of more required because you're looking at tons of data, you're looking at complex scenarios, you're looking at solutions to kind of get what you want out there. The financial market expertise is definitely required unless you have understanding on instruments, derivatives, asset classes, how it works. You will not be able to kind of do risk analysis over there. And again, charter holders are kind of best poised to kind of take on risk management roles, largely because they have the domain kind of expertise. Understanding of regulatory frameworks. So whether it is Basel for banking, whether it is GDPR from a data privacy perspective, whether it is SOX for internal audit, whether it is local regulations like SEBI, SEC, and so on and so forth, the regulatory understanding can also evolve. I have personally found that CFA charter holders do a wonderful job in compliance, risk management, because the understanding of finance is much more evolved with respect to how the market works. So for them to kind of design processes around it for mitigations and otherwise are fairly easy. You have the tech side of risk also. So a lot of people kind of work with the large quantum of data and then they have technical proficiency. So they use tools like SAS, R, Python, SQL, and one needs to be kind of there on those tools if they want to kind of looking at processing large data. From a capital market perspective, FactSet, MSCI, Barra, Bloomberg, and so on and so forth, people will provide you some of the other analytical tool. Whether you're looking at attribution, whether you're looking at other sort of stress testing scenarios and so on and so forth, but these things are kind of, available. And last thing is the ability to communicate, again, communication skills or soft skills are required because at least in risk management, you have multiple stakeholders involved, right from, someone who's doing the process to someone who's at the board level. And that kind of skill set requires you to communicate effectively in terms of what and where you think kind of, the risk kind of, works out there. From a professional sort of qualification and other perspective, majority of the licenses and other places obviously require you to have a bachelor's or a master's degree. A degree in law, mathematics, statistics, business administration, finance eco is kind of more adoptable. However, engineers are most welcome to from academic degree perspective, bringing in the analytical mindset. So as long as you meet the requirements, I think it's fairly okay. Most risk management roles which are designated in India doesn't require you to have a graduate or a postgraduate, but they would require you to have a professional sort of qualification, which are out there. From a fund management standpoint, yes, your CFA can do wonders, but there you're already competing with a large set of charter holders or otherwise who are already working in this thing. But in risk management, charter holders are a rarity, and that's the opportunity which I'm talking about. That in risk management, if you are a charter holder, you have a strong edge because someone who is a risk professional, if he's done purely quantitative work, he may or may not have a full understanding of how the markets work. And you being a charter holder can certainly bridge that gap and be that one-man show in terms of how you can look at these things. The beauty of a charter holder getting into risk management role is that not only you are good at investments, which means you can hear out the investment professionals and they can kind of they cannot make fool out of you, but you can also sort of anticipate a lot of these risks hindsight before even the things are made at the policy level, at the grassroots level, right? So the biggest kind of payback you might get from a CFA program is in risk management. Of course, investment is part of it, but within risk management, I think the payback is much higher and faster to that extent. Now, industries which are mandated to require risk professionals include banking, financial services, whether it is lending, whether it is non-lending, whether it is any of those BFSI space companies, you will require sort of risk professionals. Insurance was always there with respect to portfolio risk, actuary risk, underwriting, and so on and so forth. Consulting firms have now started sort of having separate practices for risk management, whether it is fraudulent transactions, whether it is systems, processes, reviews, SOPs, even the big fours, the big eights, or the consulting firms also now have, these things. IT cybersecurity has evolved as a new area, and trust me, the understanding of a charter holder doing cybersecurity risk is far different or higher than a plain vanilla cybersecurity expert trying to kind of help you do, cybersecurity measures in an asset management space. Because a lot of times the difference is an understanding of where the data is moving, how the data is moving, where is the risk, where is the leakage, and that part. And last but not the least, a lot of government regulatory bodies have now kind of started putting in people from risk management because they understand saying that their job is to kind of find these things in advance. Their job is for oversight. Their job is for supervision and the enforcement to that extent. So they also look for risk management professionals, every now and then to that extent. Few trends which are emerging in risk management, and again, they are kind of shaping right now and may not be there in a few years. But AI and machine learning has become a big theme over the last, I think 1 or 2 years. Advanced algorithms, which can kind of provide you risk modelings, predictive analysis, decision-making processes. So a lot of AI is getting into sort of risk management, largely because if you want to build large language models which can keep on learning from the orders itself, a practical example could be, a tool which can analyze all past SEC orders and learn and make questions and help team answer those questions based on the past orders in case whether, whatever they're trying to do is good, bad, or beyond, the acceptable limits, right? So AI and machine learning is a great sort of example. So the risk tech industry, as they call it, the fintech or the risk tech industry, is evolving rapidly, and there are tons of startups and other kind of areas which are doing this out there. Earlier, there used to be tool which are kind of more hosted solutions, but now I think with AI that thing has changed, and it's evolving. So if you have those skill sets, and if you don't have, please go ahead and develop those skill sets with respect to machine learning out there. ESG integration, yes, the trend has been there for some years, but now it has picked up. And integrating ESG into your research, whether it is, PRI standards, whether it is sustainable investing, whether it is, BRSR reporting, the business reporting, sustainability and responsible reporting. These things have gone, at the center stage. And so much so that now, a lot of funds needs to kind of disclose some of these tags which they are using and make sure that they're using these, without kind of greenwashing them. The third trend is cybersecurity or the cyber risk explosion, and that has kind of tremendously gone up in last 3-4 years. And thankfully, the regulators are all acting very, very fast. And there is a common cybersecurity and resilience framework which is out there in a domain for majority of the intermediaries. And that's a big task because a lot of these cyber risk guys understand consumer data, they understand airlines, they don't understand financial space. So huge opportunities with respect to risk management in the cybersecurity side. And the last trend is that usually the risk is always a postmortem, but with the shift of regulation and the shift of data availability and the shift of how much you can process, the shift is happening from periodic reporting to real-time risk reporting metrics. Take an example of margins. The way margins are implemented, at least in Indian markets, with respect to peak margins, with respect to opening margin, with respect to day end margin, and so many of them, they work on a constant basis, on an ongoing risk monitoring basis, with instant alerts and predictive insights on where things can go right, things can go wrong. So one these kind of things are kind of fairly important to that extent. So from an industry standpoint, I think if you want to kind of navigate the challenges, I think the regulatory complexity is increasing day by day, and the plain vanilla risk management professionals are no longer required. The risk management professionals which can understand a host of multiple other things, maybe fixed income, equity, the investment analysis, how the operations works, are more in demand with respect to there. Second thing is, a lot of places you've seen there is a concept of GCC, which is global sort of, capability centers as well as domestic businesses. Risk management is probably one of the only functions which can travel, which can fit in, which is valued when it is comes with a diverse geographic markets and cultural context perspective. So a global risk management experience is much more valued in Asia or India than vice versa. If you are in research in a offshore center or a GCC center, you might not be able to cover the same kind of sector in a domestic market, and it might not be valued. But from a risk management standpoint, you absolutely are at the you know at the center with respect to requirements over there. Innovation versus risk. So majority of the regulations now allow you to do some sort of sandbox testing. Now they want to allow competitive agility. At the same time, do you want to make sure that they are kind of compliant over there. So with the onset of crypto, with the onset of digital currency, with the onset of millions of investors trying to digitally eKYC open the accounts. There is a fine balance between innovation risk, which I think a risk management professional can provide. And the last thing is, look, brand reputation is the biggest thing with respect to any businesses. We are in a digital age. The way we consume data, the way we predict data has been very, very different. And, reputation risk is something which all of us should work on, even for our own individual without kind of looking at the risk management as a career. So the scrutiny, and you would have seen that now, people who apply for visas are also scrutinized on their social media handles to kind of check whether they were extremist or not. So the amount of usage which people are doing for reputation risk analysis, whether it is credit scoring, whether it is social scoring, whether it is matrimonies for that matter, or otherwise, it has increased tremendously. And unless you are kind of aware, risk aware of what is out there, it'll be difficult to kind of manage from there. Um, you know Risk measurement techniques, we've already spoken about this. I'll give you some examples. Again, these examples are on sample funds taken from Bloomberg. Again, this is an example of war, of how market currency style industry, what kind of war, which kind of factors, which kind of sectors are contributing to that. Examples on war at a portfolio level with respect to each individual security, each individual sector, versus the benchmark with respect to weights. I have a scenario analysis. So if a fund has to kind of go down through where US Treasury yield goes up 100% with some sort of propagation, what is the amount of P&L impact would have? If the Brexit is going to happen again, what's the impact of portfolio on that? If the equities are up by 10%, if the volatilities are up by 10% or 20%, if the EM index is down by 20%, if the SPX, the S&P 500 is down by 20%, what kind of scenarios are possible, right? And these are all past scenarios which people try to kind of calculate the impact cost. And as long as the percentage limits are in order, people can kind of look at it from that perspective. The scenario analysis can be done also at a stock level. Certain stocks have performed in a certain way, and this is kind of available to that extent. The factor sensitivity, again, beta from a US market, Indian market, currency impact, the size impact, the residual impact, and those kind of things are kind of available over there. Liquidity analysis, I told you, how much of your portfolio can be liquidated in a particular day, that those kind of things are available out there. You all know about Sharpe ratio, information ratio, alpha, beta, and those kind of analysis. So those I will not repeat. But like I said, a lot of tools are available which you can use to kind of calculate these things directly from, the benchmark itself, right? So the capture ratio, the correlation, the Jensen's alpha, the Trenner measure, the tracking error, everything is available with respect to tools out there. And a lot of these are used by institutional investors, left, right, center, every day, for looking at portfolios which they track, or the funds where they kind of invest in from there. These the idea is to kind of interpret. Nobody's asking you to calculate, but the more you interpret, the more you understand the sort of value weight of it. ESG risk rating, and this is kind of a screen from Morningstar. Morningstar again does this publicly, and there are so many of the ESG providers which gives you that sustainability scores. So one should look at that to that extent. From a regulatory ethical framework, yes, you are pretty familiar with the CFA code of conduct, but there are other regulatory frameworks which are available in each of these regulation, be it banking, capital market, otherwise, which one can kind of look at to that extent. Some of the tools which I would recommend people to learn, so obviously people know Excel, but look at R, look at Python, look at data sets like Bloomberg, FactSet, Morningstars, make sure you understand how you can best leverage some of those. Monte Carlo simulations, again, a big hit with respect to VAR calculation and so on and so forth. Those can really, really help people who are looking for making a career in risk management perspective. This is the data which I found, on some of these recruitment websites. The job growth market, at least from a risk management perspective, is expected to grow around 85%. Again, the numbers I've taught about entry-level positions in entry-level or mid-level positions in risk management careers in India, but they differ or depend based on each kind of AMC or the size of the company where you are looking at. But one thing, be rest assured, saying that risk management as a career is a global career in nature, irrespective of which country you are. The risk management kind of techniques and the tools and the knowledge which you have remains with you wherever. If you are managing a cybersecurity risk in Middle East or US or India, is going to remain the same. If you are a global risk management expert with respect to investment risk, no matter which portfolio you look at, it's going to remain the same to that extent. So if you're looking for a future proof career path. I think risk management is something which looks like, it's not going to go decrease, it's going to go increase only to that extent, to that extent. Risk specialties, again, this is based on a survey which happened, through GARP. These are the keywords which people are typically looking for. So technology, AI, data risk, sustainability, climate risk, model risk, credit risk from a hiring standpoint. And unless you have those keywords in your resume, probably hiring is not going to happen to that extent. Skill development area, again, ability to assess climate risk, technology risk, interpersonal communication, soft skills. Those are the current and future roles, kind of, to that extent, what you can identify. Hiring, again, you will see that people have kind of, understaffed to that extent where they are looking for sort of hiring. Majority of the places you'll find hiring is in full-fledged in risk management roles to that extent. So your journey starts here. Risk management is more than protecting threats. It's about enabling growth. It's like having brakes in your car. You have brakes not because you want to go slow. You have brakes because you want to go fast. And risk management kind of enables, that perspective. So a very, very dynamic career path. Very strategic impact on the growth of the business. Perfect for analytical mind, and a no compete zone for CFA candidates and charter holders to that extent. At least that's what I have kind of learned over a period of time in my career. I started my journey with credit risk, and over time kind of moved into regulatory space, and then kind of into regulatory risk and technology and so on and so forth. And investment risk comes naturally to kind of, us, because we had been trained that way. With this, I will stop talking and maybe hand over back to Rajni, and then we can take any questions from there if there are, and go from there.
Yeah. So a really, really in-depth presentation, BD, first of all. And before we move on to the Q&A, as BD mentioned that he has spent a good part of his career into risk management. A disclosure from my side as well that, as I mentioned, that I've spent close to 2 decades in the financial services industry, and close to 8 to 9 years I was spent into market risk and quantitative analytics. So, and then I moved to the dealing side. So then, both the people today who are talking to you have been on the risk management path, who are mentioning about the career paths in risk management. So BD, I will start from macro, and then we'll move to the very specific 3 4 questions which
Sure.
the audience have posted on the chat. So you towards the end you alluded that why risk management is important, because you want to run your business fast. That's why you need the breaks. Now, from the person who wants to pursue the career, A is that you are a charter holder, then you would say naturally you want to move to the investment management or various aspects of it. Why one should look at the risk management in the first place as a career option?
So look, a lot of times when people want to kind of make a career, they want the career to be global in nature. They want kind of interportability with respect to where they want to do it. Take an example, very simple example. You started your career with, an exchange doing risk modeling or maybe
Right.
regulatory risk to that extent. And it was very easy for you to kind of move that risk into, let's say, valuing credit. Very easy for you to move that risk into, a DCM kind of a space, or
Right.
very easy for you to kind of, understand it from client's perspective, what he needs, right? I started my career with, credit risk, and they eventually kind of moved on to, the wealth side, and then moved on to, the investment side to that extent. So the amount of, interportability I've seen with respect to risk management careers is far, far higher than, other places. So I have not seen many fixed income managers suddenly started managing equity. I have not seen many equity managers suddenly starting managing, fixed income and vice versa. So I'm not saying all other careers are good or bad, but I'm saying the amount of fungibility one would get here is far higher than anything else. And when you want to start a career, you certainly want to kind of look at a career which can give you options, right? Uh,
Right.
and I talked about global nature. A lot of places, your global experience, even though it is of, valuation or otherwise, might not be kind of valued in when you're looking for a domestic market role. Risk management is one such function where you have a red carpet welcome if you have a global risk management experience, and people want to kind of adopt you because they want to learn, they want to kind of evolve to that extent. So I would say whosoever is looking at a career, they typically want to sort of start in a career where they have a first mover advantage, they have interoperability, they have global nature of this thing. And I keep on saying this jokingly to people, saying that everybody wants to become an equity research analyst, right? So there's already a lot of competition out there. Nobody wants to become a risk management professional. So here is the
Yeah.
chance which you might have.
And to add another dimension to it, you mentioned the interesting aspect that it's a career where the portability of transferability of skill is very higher.
Right. Hi.
And then when you look at the career, it is typically 30-40 years when you look at it, when you start at maybe 20, 21, 22. So, and the world is very evolving. So having a career which provide you lesser options as opposed to a career which has which gives you more options is always a better option from the long run point of view. So from that context, risk management is really one of the lucrative areas to look at it. And another question I would want to ask is that you mentioned the various type of risks in your slide, be it credit risk, market risk, regulatory, cyber security, technology, and ESG, etc. A gamut of risk management fields. Now, uh, any analyst would start, though you cover a lot of areas in your slides, but to give a very 30,000 feet view of what are the areas which would be quantitative, therefore closer to the investment functions, and what are the areas which would be, more from which give you a overall and broader perspective and therefore increases the horizon. So depending upon the objective which one wants to achieve, probably choose the area at the analyst level and then later on decide the path to move.
So broadly, look, anything to do with investment risk and credit risk is always going to be more quantitative in nature, because you can have fundamental risk, guys, you can have quant risk guys, you can have, for example, in credit space, a credit space, people can be on the banking side, on lending, people can be on the, investment side from a asset management perspective, and people can be on, co-lending or so on and so forth to that extent, right? So the skill is interoperable, right? So if you are let's say, evaluating credit in a bank, or if you are evaluating credit for an asset management company, or if you're evaluating a credit for a, AIF or a PMS to that extent, you are still going to look at the same ratios. You're going to
Right.
still look at, your payback period. You're still going to look at whether your covenants are covered or not, right? So the skill set is common across, right? Similarly, on the investment side, and the reason I tell people to kind of look at risk management is that, look, if I hire a risk management professional who is not from a finance background, I need to tell him what each of these ratios means and how they are calculated and why the analysis is different. You as a charter holder would already know a lot of these things, and hence the job is far easier for you to kind of, develop that understanding into something else, right? As they say, so for example, the risk for you, a common person would understand, let's say the price of the stock is earning multiplied by P ratio, right? Now, a normal person might say that earning will expand and hence, the stock price should increase. A risk management professional can also say that, look, your returns could come by earning expansion or PE expansion.
Right.
And your earning might expand, but your PE might, deflate, and you still might be at the same price. Right. So
Right.
that understanding will only come if you are kind of, if you're good with finance. So I'm saying, look, the people always want a mixed flavor, right? A plain vanilla risk management might not be do that well if unless you have a added advantage to it, right? So if you already know, so take an example, if you already know the valuation of bonds, if you already know the credit analysis of bond, if you already know the rating process, tomorrow when you go and sort of want to be in an investment banking firm, pitching, DCM to your client,
Right.
that capital market is far easier for you because you know all the technical aspects of it.
So you have all ingredients in place. Then
Ingredients
it's
in
just
place, a lot
matter
of
of
those ingredients, kind of start with your, knowledge of finance or accounts, or what you learn in CFA sort of curriculum to that extent. So what I'm trying to say is that, look, people might think that this is quantitative or qualitative, but eventually both comes in handy. Everything is going to help you. So any credit analysis that you do, you always looked at management quality,
right.
right? If you're doing a private equity investment, you're looking at promoter or
Mm.
founder quality. If you're looking at equity, you want to understand whether the management is good, bad, or what is the corporate governance, right?
Mm.
So only the lens is different, but you're still looking at the same thing. So I don't think it's very easy to kind of differentiate between saying I will only do quantitative risk management or I'll only do qualitative risk management to that extent. I think it comes as a bundle, some qualitative, some quantitative, and a mix of those to that angle.
Right. And so, today AI adoption is everywhere, and no conversation can, remain uh, complete if we do not add the AI dimension to it. And one of the questions have also come in the chat box, that given that a lot of things are automated, and say for example a lot of dashboards which you presented in your slides as well, wherein ratios were calculated, or a lot of spreadsheets which readily come out. So if I look at the risk management career, say 15 years earlier, a lot of bandwidth would go into either understanding the formula or training the system so that system can generate some sort of formula. So therefore understanding formula becomes a key to it. That is one layer of it. But now that part is already done, then interpreting it becomes very important. The question somebody has posted is that since AI adoption is very rampant these days and a lot of things are possible and are being automated, then what qualities or what part of the career in the risk management remains due to say AI proofing?
So fair point, Rajni, to that extent. I think the only career where AI cannot disrupt is risk management. And largely because it is very, very subjective to that extent in terms of what is risk, right? So for example, for a high beta trader, a risk might be something else. For a value investor, the risk might be something else. For a growth investor, risk might be something else. So I think depending on the type of investment, the definition of risk changes. It's very relative to the business in which you are in. So if you're a high grade trader, you'll only look at high grade, and high yield might be a risk for you. If you are a high yield trader, junk is okay for you to that
Mm.
extent. If you're an insurance company, you can only invest off AA and above. If you're a
Right.
pension company, you can't invest in a corporate bond to that extent. If you're a mutual fund company, you have to maintain the duration of 60 days for certain funds and overnight for certain funds. So I'm thinking all of them still looking at the same thing. But the relevance changes with respect to where you are working. And risk is the only kind of function where AI more than kind of, resilient. I mean, it can make you more resilient because it can give you so many scenarios in one place, right? So what is AI doing? It's trying to kind of, compute multi-dimensional, supercomputer power and give you scenarios and analysis of multiple things, right? We understand that you as a standalone person might not be able to do it yourself, but AI can give you all of them together. Now, to make a judgment out of it, to make, sense out of it is where I think the value is, right? Uh, 10 years ago also the value was, and all of you would read the DuPont analysis, right? That 10 years ago the value was not in calculated ROE. The value was in understanding whether the ROE is driven by asset turnover or operating leverage or profit margin. I think take that example, that with AI you can do the DuPont of risk management, right? You can
Right.
identify, pinpoint, you can more accurately kind of do it to that extent. I'll give you a very small example, and I heard this recently. There was an eye doctor which said that when we do these surgeries, laser surgeries for people with glasses, we typically do the surgery and obviously people are able to see after that and so on and so forth. But now we are kind of running these simulations of surgery on AI based, let's say, a simulator. And we are able to kind of, the AI simulator does almost 10,000, changes with respect to laser. And now they're able to exactly figure out, saying that if you do these 5, 10 different changes, people are able to view more. So the AI enabled kind of these surgeries, again, right, wrong, I don't know, but I don't wear glasses. But the point is, he was saying that people are able to see more clearer with those surgeries than what they were before. Surgeries were successful in both of the cases, but the impact is higher, and that's what I think AI can do with risk management. It can give you more clarity, more pinpointed answer, more broader slicing, dicing over there. Yes, for calculations, people are using a lot of productivity hacks and people will use AI also to do that. So right now also, like I said, you have Bloomberg, you have FactSet, you have a lot of these data points which will give you whatever it is required. But someone needs to analyze those, right? So if the portfolio is underperforming, you need to kind of, find out and identify whether it is because of sector or security or allocation or selection or beta or residual. What is it that, it is impacting? And people want genuine reasoning. And I think reasoning is what I think, a non-AI risk management sort of person can give. So I think this is the most AI resilient career which someone will ever find. But again, I might be wrong.
So that, building on to this, I move on to my next question. So two things are very important. Even if, say, let's say AI software is giving you something, interpreting it. So that again has two things. One is understanding, second is communication. What happens is eventually, let's say you are a risk manager, and let me put it in the context of a, let's say, asset management company. A fund manager is evaluating some risk report. Fund manager is, he or she is reading, and if they are not able to figure out, what they typically do is that, they focus on a couple of numbers which are relevant for them. Tomorrow, let's say they focus, some aberration is coming into getting flagged off in the report. It becomes very important for the risk analyst at least to, interpret it for the fund manager so that they are able to understand it.
Yeah.
So therefore, understanding plus communicating in a language which a counterparty understands, it becomes very important. And second is on the technical grounds. A question has come in the chat box that how important it is for somebody who is, starting their career to learn the Python or any other technical part, which I think is very important if you are moving in a particular area of this. But we would want to hear it from you.
So a fair question, I think, Rajni. If there are a lot of CFA candidates on this, webinar, they'll identify that Python is now an optional subject available in CFA level 1 curriculum. And the reason why it is included is that, look, people started with C, C++, then moved on to VB, then moved on to some other language, and so on and so forth. If you're looking at large amounts of data, if you're looking at time series data, especially the financial side of it, if you're looking to kind of, build in your own systems, logics, thought processes, then Python is the most fungible kind of, language to that extent. And that is why there's so much focus around the world on, Python. So absolutely must sort of for any investment professional, not just risk professional, any investment professional to kind of know Python, because that can evolve, help you kind of do a lot of these analytics. See, a lot of amount of data which you're getting in Excel in structured format, unstructured format, from host of sources to that extent. You will need some common code to kind of take those data points together and make a sense out of it. And that ease of making those decisions or those decision trees is possible in Python. So absolutely must required from someone who's going to start sort of career in there. With respect to your other questions in terms of data reading, yes, interpretation is the most kind of important and communication is required. But I believe someone who understands the grounding of the calculation is able to do far better, higher job in explaining than other players, right? Look, you might have underperformed as asset manager, but it is important to communicate to the client saying that you underperformed not because of your selection effect. You underperformed because of your allocation effect. Maybe some sectors which are very, very highly valued has gone up, further. Right? If your strategy is kind of more value, you are never going to invest in those sectors. But people end up comparing you with a large index or a market index, right? And that understanding can help you kind of communicate those things better. So attribution is a great example which most kind of investment professionals use in terms of explaining their returns, so slicing, dicing their returns to that extent. So one of the things, let's say, which I showed you, and we do this occasionally, is that yes, you are outperformed, but is your investments or is your returns coming from selection effect? You are saying I'm a fundamental bottom up guy, right? Or someone who's saying I'm a macro asset allocation guy. But are your returns telling the same story? In your returns, is the allocation effect higher or the selection effect higher? Now, let's assume you find that answer. Is that the same across market caps? Can you say that, okay, is it the same behavior in small cap, large cap, mid cap? Is the same behavior across, let's say, banking, where some other ratios work versus manufacturing or otherwise? That amount of analysis and explanation, I think, whether it is wealth management, whether it is investment management, whether it is regulatory side, is available in a risk management career, right? So sometimes they know more than the fund manager himself, right? And that's the kind of idea.
That brings us to a very important aspect. See, what happens is that at the end of the day, you be a asset management house or a wealth management house, or for that matter, any money management function. Eventually, your future business depends upon your performance. Now, how your performance is communicated, it becomes very critical. Therefore, risk management as a function or career, as we say that, it's strategically important from the overall perspective.
Absolutely. So investment side, yes, it's the most organization have. Like I said, apart from the mandatory role which a regulator requires, I'm saying even in wealth management firms. Now,
Mhm.
I mean, you might some people know them as investment product guys.
Right.
The role of investment product guys, apart from finding out what the market is doing, is also to do risk management analysis, right? They are the ones who are communicating with large distribution houses or clients to figure out, okay, this is what their monthly data looks like and whether they are adhering to that strategy. So if the manager has said something and you want to check whether they are adhering to it, the only way to do that is through a risk management sort of, function.
Correct. So, in the interest of time, I'll move on to my last question. Now, one of you had very interesting slides which mentioned that currently pretty much risk management as a function is understaffed across this thing,
Yeah.
which means that a lot of asset management house, particularly in Indian context, a lot of AMCs are getting registered now, and mutual fund houses are coming into picture. If we look at the existing data, there is understaffed and new players coming into market. Obviously, that brings us to the one direction that there would be hiring, opportunities there. What's your view on that?
So you're absolutely right. So one is CRO, the Chief Risk Officer is a designated function in asset management space. So any new MC which wants to come in, I'm talking about the mutual funds, they have to have a CRO out there. And if you typically look at CRO, apart from all other risk which you might there, they're typically looking at investment risk and they're looking
Mm-hmm.
at operation risk.
Right.
Investment risk is fully quantitative. So a charter holder, CFA charter holder can do a great job because he understands most of the ideas out there. Whatever is the investment team providing you, you need someone with equivalent competency to understand and analyze and dissect those,
Right.
right? And operation risk is wherever things can go wrong, which happens through the RCSA, the risk sort of control sort of matrix to that extent. So large part of, and I wouldn't put a number, but let's put it 70-30, that majority of
Mm-hmm.
the risk management roles, at least the AMC side, would 60-70% focus on investment risk because that's the core of what they do, and maybe 30-40% on the other risk which out there. As regards like roles like cybersecurity, you will have a designated CISO in the organization to support you or give you that specific guidance. For
Mm-hmm.
operations, you will have a designated chief operating officer to give you that guidance on, what it takes and how to kind of, do that. For secretarial, you will have a company secretary to kind of support you. For finance risk, you will have, a person to kind of support you. But investment risk, you'll have to do it yourself, right?
Yeah.
You are the ones who is on top of what investment team is doing and stating. You will be the independent body or person to kind of respond to board or stakeholders talking about what is required and what is not required. And having a charter holder status obviously helps there because you know what it deep down means, right? So you can dissect the data easily and kind of go from there. So even if you have investment risk expertise, I think 60-70% of your role is already covered. On top of that, if you have ESG or something else, it kind of makes it you a killer combination.
So then in last 1 hour, then we have come to a very important conclusion. Risk management as a career option or a area. A, obviously CFA skills are very relevant. It's not only relevant, it acts as a differentiator. Therefore, you can perform really
Yep.
well. That is one. Second, there are, as you mentioned, that hiring trends, probably there would be requirement of more and more risk professionals. So therefore, it is relevant at the moment. And third, you mentioned from the AI perspective also, and the mobility from the global perspective. So these are 3, 4 important areas, especially a person looks into when while having the career. Every ingredient is there in this risk management as a career option. So we leave this, complete this webinar at this very high note. I would request each one of you to please fill up the feedback form, the survey which has been shared. And thank you, BD, for being with us
Thank you,
and
Rajni.
giving our audiences a very insightful conversation.
Thank you.